Hello everyone. Today our topic is admission of a partner. According to Indian Partnership Act 1932, the definition of partnership or partner or firm and firm name. Partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. Persons who have entered into partnership with one another is called individually partners, and collectivity a firm and the name under which their business is carried on is called the firm's name. From the above definition of partnership, the essential elements of partnership can be understood as partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. Merits of partnership. The partnership form of business organization enjoys the following advantages that I describe right now. The formation, ease of formation. Partnership is simple to form, inexpensive to establish, and easy to operate. No legal formalities are involved and no formal documents are to be prepared. Only an agreement between two or more persons to carry on a lawful business is required. Even the registrations of the firm is not compulsory. Similarly, a partnership can be dissolved easily at any time. Larger financial resources. It is possible to collect a large amount of capital due to a number of partners. New partners can be admitted to raise further capital whenever necessary. And credit worthiness is also high because every partner is jointly and severally liable for all the debts of the firm. Combined abilities and judgment, the skill and the expenses or experiences of all the partners are pooled together. Combined judgment of several persons helps to reduce errors of judgment. The partners may be assigned duties according to their talent. Therefore, benefits of specializations are available. Partners meet frequently and can take prompt decisions. Direct motivation, ownership, and management of business are vested in same persons. There is direct relationship between effort and reward. Every partner is motivated to work hard and to ensure the success of the firm. Losses are shared and there is diffusion of risk. Close supervision. Every partner is expected to take personal interest in the affairs of the business. Different partners can maintain personal contacts with employees and customers. Fear of unlimited liability makes the partners cautious and avoid reckless dealings. Management of partnership is cheaper when expert managers are not employed. Flexibility of operation. Partnership business is free from legal restrictions and government control. Partners can make changes in the size of business, capital, and managerial structure without any approval. The activities of partnership business can be adapted easily by changing conditions in the market. A partnership firm is not required to establish or publish its annual account. Audit of accounts is not essential, and no reports are to be filed with the government authorities. Therefore, the affairs of a partnership business can easily be kept secret and confidential. Management of partnership is democratic. Every partner has a right to be consulted and express his opinion. All important decisions are taken with the mutual consent of all the partners. In case of partner is dissatisfied with the majority decision, he can retire from the firm or give a notice for its dissolution. Partnership encourages mutual cooperation and trust amongst people. Partners work in common for the benefit of all and do their level best to make the business prosperous. They can take more balanced decision than one man. There are greater possibilities for expansion and growth of business. More partners can be taken in the meet the financial and managerial requirement of growing business. There is a limit to the maximum number of partners in a firm. Therefore, it is not possible to collect huge financial resources. Borrowing capacity of partners is also limited. A partnership firm may not provide the required technical and administrative skills. There may be a lack of professional management. Every partner is fully liable for the debts of partnership business. Fear of risk may restrict initiative and growth of business. Private properties of partners can also be taken up for business liabilities. Partnership business suffers from instability, insolvency, insanity, retirement, and death of a partner may cause an abrupt end to business. Any partner can give a notice for dissolutions of partnership. Lack of confidence, unity, and harmony among partners may lead to delayed decision and inefficiency. Chances of conflict are high because every partner has an equal right to take part in the management of firm. Every partner is an agent of the firm. A dishonest partner may cause a great loss to the firm. Other partners may suffer a heavy loss due to the dishonesty or negligence of one partner. A partner cannot transfer or assign his share in the firm to a third party without the consent of other partner. He can or he has therefore to lose the liquidity of his investment. A partnership firm does not enjoy high degree of public confidence and prestige. This is because it is free from legal formalities and government restrictions. Its accounts are not published and public is not aware of exact position of the business. A new partner can be admitted only with the consent of all the existing partners. A new partner is not liable for any profit or loss occurred before his admission. Such a partner is called a new partner or incoming partner. Now, purpose of admission of a partner: for additional capital, for progress the firm, for acquiring additional managerial skill, for reducing competition. Admission of a new partner is a major event in a partnership business. A new admission can take place only with the unanimous consent of all the existing partners. New partners are admitted for several reasons: additional capital contributions, fresh ideas, more contacts, etc. are some of the advantages in admitting a new partner. Now, change in profit and sharing ratio, accounting treatment of goodwill, revaluations of or revaluations of assets and liabilities, treatment of reserves and accumulated profits and losses, and adjustment of capital accounts. When a partner comes into the business, old partners have to adjust his profit share from their portion. Thus, change in profit sharing ratio in the first accounting aspects to be considered on admission of a new partner. In academic accounting, change in profit sharing ratio can be presented in various ways. The new partner's share is mentioned without specifying the old partner's profit sharing arrangement. In this case, it is to be assumed that the profit available after paying the new partner share is to be divided by the old partner's share in their old profit sharing ratio. In other words, even though the overall profit sharing ratio changes, the old ratio is still maintained between the old partners within the new ratio. The ratio in which the old partners agreed to sacrifice their share of profits in favor of the incoming partner is called sacrificing ratio. The sacrifice by a partner is equal to old share of profit minus new share of profit. As stated earlier, the new partner is required to compensate the old partners for their loss of share in the super profits of the firm, for which he brings in an additional amount known as premium or goodwill. This amount is shared by the existing partners in the ratio in which they forego with shares in favor of the new partners, which is called sacrificing ratio. The ratio is normally clearly given and agreed among the partners, which could be the old ratio, equal sacrifice, or a specified ratio. The difficulty arises where the ratio in which the new partner acquires his share from the old partners is not specified. Instead, the new profit sharing ratio is given. In such a situation, the sacrificing ratio is to be worked out by deducting each partner's new share from his old share. Revaluations of assets and liabilities is another major step prior to admissions or retirement, and revaluations is important as there are hidden profits or losses in the difference between book value and actual market value of assets or liabilities. Revaluation is necessary whenever there is a change in profit sharing ratio, even without admission or retirement. The hidden profits or losses should be distributed in the ratio prior to change. Old ratio, revised value of assets and liabilities are brought into books by operating and temporary account called revaluation account. The purpose of revaluation account is to summarize effects of revaluation of assets and liabilities. Revaluations accounts represents the combined capital account of partners. Any gain on revaluation of asset or liabilities which are to be credited to partners will be credited in revaluation account. Similarly, any loss on revaluation will be debited in revaluation account instead of capital accounts. The revaluation account is closed by transferring its net balance to partners' capital accounts in the profit sharing ratio. Accumulated profits such as general reverse, credit balance in profit or losses account, etc., will be transferred to the capital accounts of old partners in the old profit sharing ratio. Similarly, accumulated losses shall be transferred to the debts or debits side of old partners' capital accounts. Therefore, these items will not appear in the new balance sheet. When the partners change their profit sharing ratio at admission, retirement of any other reason, they also rearrange their capital accounts. Capital contribution is not essentially the basis of profit sharing. However, in most partnerships, capital contribution is considered as the major factor in determining profit sharing ratio. At the time of admission, capital contribution will be raised as an important condition when a new partner is admitted for a certain share of profit for a certain amount of capital contribution. He would naturally expect the other also to maintain a capital balance and matching with their profit share. Admission of a partnership or partners is not the only situation. Balance or situation when the capital rearrangement is considered. Retirement, death, or any other change in profit sharing ratio would prompt rescheduling the capital balance. The basic purpose of following fixed capital method is to maintain a steady capital ratio. So that's the end of the video, my friends. If you like my blogs, please subscribe and share it. Thanks.